Well, fixed income or equities, North American equities or overseas, these are the kinds of decisions that investors need to make right now. Not so much about individual selection, but more about asset allocation. And some would argue that is the most important decision right now. Here to discuss that on their latest note called Forward Perspectives, I'm joined by co-chairs of the Wealth Asset Allocation Committee at TD Asset Management. I've got Bruce Cooper beside me, Vice Chair of Active Equities and Fund of Funds. And beside him, Ken Miner, Vice Chair of Fixed Income Derivatives and Currencies. Those are long titles. I think we could finish the interview right there with the titles. But before we actually get into the note, let's start off with the foundation underneath the note right now, which is your theory on what's happening with debt and the high levels of debt around the world.
So thanks, Kim. So we have this view, we've held it for many years for people who have been following us, that debt has reached levels in developed markets that we're now implying a persistent period of lower economic growth and lower returns. And the way we've adopted or observed this in our portfolios, we say if interest rates are going to be low for a very long period of time, right now we're thinking end of 2015, 2016, it gives us that low rate, gives us the view that we would prefer equities to fixed income as the way investors will protect the real value of their savings.
And so that thesis remains intact,
Yeah,
given
absolutely.
your outlook for where things are going.
Exactly.
Okay, so Bruce, you do wear the equity hat here, which means I'll be hearing more from you than from Ken, I think, in the next few minutes. The continuing case for equities is the name for this. So tell us a bit just about the premise and what that's based on.
Well, we have preferred equities over fixed income since 2009, and we haven't altered from that one iota, and we continue with that view.
Which has been a good call. Kudos.
Thank you. We want to revisit the call just in light of the fact markets have run, and of course we are seeing a change in central bank behavior from the United States. So we're getting a lot of questions. We thought it'd be a good time to just review where we stand on the equity call today.
Okay, so your premise, if you look at the note, you talk about basically three premises that are supporting the thesis. The first one is central banks are still doing what central banks are doing, and they're still adding more to, as you talk about the leaves in the pile in terms of quantitative easing, but it is beginning to taper back.
Well, one of the underpinnings of our equity call has been that we have this liquidity tailwind for equities, and we still think that's the case even with tapering. And there's three reasons I would cite for that. First is, even though the Fed is tapering, which means it's buying fewer bonds, it has signaled it's going to keep interest rates very low for a very long period of time. So investors are still faced with that difficult choice. You know, I can go to cash, but I'm going to earn nothing on it. And so I think that basic situation provides a nice backdrop for equities. Second, although the Fed is buying fewer bonds, it's still buying bonds. We think in 2014 it'll buy just as many bonds as the federal government is issuing to finance its deficit. You know, so I think that's a great situation. And lastly, from a liquidity perspective, if you look globally, there's still a big liquidity tailwind, we think. The Bank of Japan is being very aggressive, the ECB has cut rates, and so it's not just about the Fed, it's about the aggregate size of central bank balance sheets around the world.
What about, though, at the margin, when the Fed does finally finish the tapering, are we going to get some sort of reaction to that? Like, I understand what you're saying, other central banks will jump in, rates are still low, but at the margin, could we see something?
Well, I think we saw an initial reaction when the Fed first started musing about tapering last year, but I think now it's very much understood that the Fed is on a glide path to reduce quantitative easing, and that's fully understood by the market, and the market has looked through that.
Second premise you have in the note here is the economic upswing. So when tapering tapers, you're going to have an upswing in the economy to help grow earnings in companies.
Yeah. So we think of this like the game of tug of war where everybody's on a rope. In the last couple years, we've had one guy on the rope and a couple other people sitting on the bench. The person on the ropes being the United States has been pulling, but Europe has been kind of missing in action, and Japan's kind of flipping and flopping. We think this year is going to be interesting because everybody's out pulling on the rope in the same direction. The U.S. economy is growing, Europe is growing, not quickly, but it's growing, and Japan is growing. So the big major economies of the world are all going in the right direction. I think that's creating an environment which is good for earnings. You've got a solid backdrop for earnings, and we're really not in the business of forecasting GDP growth. We just care, is this an environment that is good for companies? Can they grow their earnings? And that's good for equities.
I know I tend to follow a lot of the daily minutia. I'll be the first to say that it's minutia sometimes in the news, but I feel as though I've heard companies, we're hearing more and more cut guidance and cut earnings outlooks. Does that affect your outlook?
Well, there's always a lot of noise when you pass through earnings season, and we just have passed through Q4 earnings season. But when you step back and look at the data, about 3/4 of companies beat estimates in the fourth quarter, which is actually better than normal. And we have not seen any major impact to earnings estimates for 2014. We're still expecting, the market's expecting kind of mid-single-digit earnings growth. We actually think it could be mid to high single-digit earnings growth. So we're very comfortable with the earnings backdrop that we're seeing today.
That's a very gracious and polite way of saying, no, Kim, you're wrong, but I appreciate that. The third premise, though, and again, we have seen such upside in the markets, especially the S&P 500 and the U.S. markets in the past little while. People are pointing to valuations.
Yep.
Can they really get higher from here?
Well, the market today, both in the U.S. and Canada, trades about 15 times earnings. 15 is the long-term average. So we're not necessarily saying the multiples are going to expand from here. I think the major drivers of return will be that earnings growth I talked about, and of course dividend yield. But we think 15 times multiples are very well supported, and really the key driver of that is is interest rates being at very low levels. Some of the work we've done shows that as long as long bonds are sort of 4% or less, then
long being 10 years.
the 10-year bond, 10-year bond are 4% or less, you could see multiples in the mid to high teens. I think that's very much where we are. The other big thing to remember is investors are starved for yield today. And I think they're looking to the equity side of their portfolios for income as opposed to the bond side of their portfolio. We're seeing companies continue to grow their dividends, and that underpins valuations because the 15 times earnings multiple also translate to something like a 2 or 3% dividend yield,
right.
And that's very competitive with bonds where they sit today.
Just to highlight that, because for people who get the note, they really should look at it. There's some great some graphs in it. You talk about the 10-year bond hitting 4%, and you see valuations will expand to that point. Where are we now in the 10-year?
Well, at 270 today, okay. So we're a long way from 4%. So 4%, we're saying that might be a point where multiples start to go down again. We're a long way from there. And there's still a possibility you could get multiple expansion between now and then.
Let's talk about red flags that might be out there, and Ken, to bring you back in the conversation. I won't ignore you. I know it's all been about equities to this point. We've seen, the North American markets, specifically states, have done very well. Emerging markets, not so much. We've seen some pretty dramatic drop-offs in currencies and in the stock markets. How do we know, how do you know that this isn't a replay, let's say, the Asian financial crisis?
Well, I think the really important point of the emerging markets is that all investors through the media have been trained emerging markets are a really big deal. Certainly they helped lift Canada for some time. So we understand the focus on it. We've looked through the emerging markets, and it's not just, they're not all the same. There's individuals. We can package a group that we would call the weakest emerging markets. And we'd say if you add up their total value of their economy in a year measured by gross domestic product, you'll get they'd all add up to about 7%. And they all have current account deficits. That means they need capital to come in, and they have trade deficits as well. They don't have a lot of tools to protect themselves, and so you could be worried about them, but they're a small issue. If we look at the larger EM countries, they collectively are about 15% of world GDP, and they're all running current account surpluses of about 7%, massive, and they've got absolutely enormous foreign currency reserves. So they have all of the tools to handle any kind of crisis.
Which wasn't the case before.
Which was not the case when you looked at the late 1990s, when the last time that was a really big deal. So it is a concern, but for us the real question is, does it mean that we don't believe in our thesis anymore? And we think that they will not create the contagion that undermines the thesis we have, which is a preference for equities over bonds to protect the real value of investor savings.
And on that, we will leave it. It's a pleasure to have you both here.
Great
Thank
to be
you.
here.
Bruce Cooper, Vice Chair, Active Equities and Fund of Funds, and Ken Miner, Vice Chair, Fixed Income and Derivatives and Currencies. I'm Kim Parley. Thanks for watching.